Hi, my name is Khleif, and I'm the host of the Lifetime Cash Flow Through Real Estate Investing podcast. And every week I interview multifamily rock stars, and we talk about how they've built incredible wealth for themselves and their families through multifamily properties. So hit the like and subscribe buttons to get notified every Monday when a new episode comes out. Let's get to it. Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Khleif, and I'm thrilled you're here. I am super excited to interview the gentleman that I'm interviewing today. Now, his name is Harry Dent, and I will tell you that if you study or stay on top of or track economics in any way, shape, or form, you have heard that name. Now, Harry got his MBA from Harvard Business School, and he studied economics there. Kind of got a little disillusioned by what he thought was vague and inconclusive work around that topic, and so threw himself into studying finance and identifying and studying demographic and technological and consumer and other trends that have helped him forecast economic changes. And I will tell you, I saw Harry speak, and I don't know if it was 20 years ago, 23 years ago, but it was in Vancouver. And had I listened to Mr. Dent, I wouldn't have lost $50 million. So I take what he says very, very seriously now. Now, Harry's been featured on Good Morning America, PBS, CNBC, CNN, Fox, been in Entrepreneur Magazine, Fortune Magazine, Success Magazine, U.S. News and World Report. I could go on and on. And so, guys, listen up. He's written tons of New York Times best-selling books that have predicted booms and crashes, and just super excited to have him on the show. Harry, welcome, my friend.
Yeah, nice to be back, Rob.
Thank you. Yeah, so I also had Harry speak to my multifamily boardroom mastermind. As you guys know, that's the group that's got billions and billions in assets represented by the operators. And I was so impressed with the presentation, I wanted to get him on the show so that the rest of you could hear what he had to say. So, Harry, can you talk a little bit about where you arrive at your conclusions? I know when I first heard you speak, you know, one of the biggest factors involved in any economic predictions, as it were, or you know, trying to get a glimpse in the future, are based on population and growth and demographics and spending cycles as associated with that. Can you speak to that a little bit?
Well, you know, what I learned really quick when I started studying economics is economists and politicians think that governments drive economies. I'm like, what? 70% of GDP in the United States is consumer spending. 10% is capital investment of businesses that only invest if consumers are spending more, and only 20% of it's government, and they're the laggards. They don't lead trends. They don't start new innovations except occasionally. So people are studying the wrong thing. I studied people. I was a business consultant at Bain & Company for Fortune 100 companies, and then for new ventures in California in the early 80s when the baby boom was just entering the workforce. I learned two things really quick. This was a different generation. It was a changed generation, and there was a boatload of these people. It was the biggest generation. It was a 10-foot wave as a generational wave versus a 3-foot wave of the generation before or the millennial wave afterwards. So I started studying the baby boom, everything about them, and it just happened at that time in 1981, first year, the U.S. government started doing an annual survey of thousands of consumer households and measured 600 categories of spending, not only total spending and saving and house buying, and potato chips, for crying out loud.
Wow.
So I discovered why demographics were important, especially with the size of this generation. And I discovered, my gosh, there's a gold mine of information nobody's looking at. Economists don't have a clue of this stuff, not even a clue. Even after the baby booms caused the greatest boom in history, I saw, Rod, I get credit for forecasting how strong the boom of the 90s would be back in the late 80s and early 90s when we were in a recession. But my best forecast was the fall of Japan. Japan's real estate and stock bubble would burst, and Japan would go into a 12, 14-year downturn and never be the same because of demographics. Their baby boom came earlier than ours in Europe and most of the rest of the world. The baby boom in itself is a bubble generation because there's so many of them. Everything they do, they put pressure on demand versus supply and create bubbles. even in jeans or whatever, or eat fat. And so they had the real estate bubble before us. They had the stock bubble, and it crashed. And economists never learned from the Japanese. I'm like, why aren't economists studying the Japan bubble, how it collapsed, and why? Of all things, real estate, stocks came back partially in bad demographic. Real estate never bounced in Japan. 30 years. Wow. How do you explain that? You know what I found out? Older people, the larger baby boom, dying in real estate is the only industry of consumer significance where it lasts forever almost. Not unlike cars and clothes and food and most of the stuff we buy. So when people die, they become sellers. And so I can't just measure the buyers like I do other categories. I have to subtract the sellers from the buyers in real estate. And that explained why even when the millennial generation came in Japan, again, ahead of us, they didn't get a bounce in real estate like we would or something. So I learned demographics was important. I also learned, Rod, I'm like, why didn't anybody discover demographics before? Well, I knew, first of all, the baby boom was so big, it made it more obvious. But right. I also realized when I went back, Rod, that before World War II, everyday people didn't make much money. They called the Malthusian trap. Everyday wages were nothing for thousands of years until the Industrial Revolution came along, and then more important, the mass production and assembly line. The first generation to be a middle-class generation and be able to afford a house on a 30-year mortgage was the Bob Hope generation entering the workforce after World War II. And they were the first middle-class generation, and they created a generational boom, very obvious, on a 44-year lag for peak spending back then. And then the baby boom came behind them, much larger, on a 46-year lag for peak spending for them, and created a bigger boom. So I was able to document how a 46-year lag for peak spending causes booms and busts in generational cycles. It was just 44 for the Bob Hope, it's 47 for the millennials. But I mean, again, these things, it's the simplest indicator ever invented, Rod, a 46-year lag for peak spending on the birth index, which I do have to adjust for immigrants, which I do, legal and illegal. Mm-hmm. And economists do all this complex analysis, and I predicted the whole boom, how big it would be, the boom of the 90s, it would continue to 2007, then we would have a weak economy. And guess what? After 2007, we've been living on quantitative easing ever since. Oh, guess how long Japan's been living on printing money to replace bad spending since 1997. Their generation peaked in 1996, ahead of us. So demographics has become one of the most important cycles. I since added technology cycles, geopolitical cycles. My number one theme, I was not a demographic expert. I've always been a cycle guy. And I first understood cycles in inflation back in the 70s when that was a big deal. When I was studying history and stuff and finance and in school and stuff, I was getting all the gold bug newsletters because inflation was big and gold is the best way to play inflation and blah, 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 blah. So I was a cycle guy. But demographics became important for the first time in World War II. But I also had to realize there were other important cycles. There's a 45-year technology cycle and a 35-year geopolitical cycle. You put those three cycles together, Rod, I can tell your grandkids when they're going to face a downturn as deep as I'm predicting for the next few years for us. I can tell them decades in advance.
And that's what we're talking about here. That's why I wanted Harry on the show, is because he is predicting a massive downturn like right around the corner. I mean,
not because of the virus.
Right, not because of the virus. So when do you anticipate this thing to begin?
Well, it did begin in early 2020. The normal cycle would have peaked in late 2019. The virus was the perfect trigger. People understand the virus was the perfect trigger. This crash was going to happen sooner or later anyway. Governments have been pumping up the economy artificially since the crash into early 2009. That crash normally would have lasted another couple of years and been much more devastating, cleared out a lot of debt and excess prices. And it didn't. They didn't allow it. But so this bubble's been waiting for a trigger. And also my 45-year technology cycle, which is actually even more powerful in history than the demographic cycle. That's the one, that's the last of my cycles to hit here in late 2019. So we were due 2020 to 22 to go into a deep downturn with the confluence of all my cycles and this bubble that's so artificial that means it's going to have to burst more. If we'd have just taken our medicine in 2008 and let the recession like 29 to 32 last into 2010 or the depression, then we would have been over the worst of this long and been in a whole different position. But no, governments decided to take the easy way out. Oh, we'll just print trillions of dollars.
Right.
So that's not, I don't know why anybody thinks that could possibly be good policy, including Warren Buffett and major bankers and major economists. This is the stupidest single thing I've seen in all of economic history. And everybody's saying, oh, well, the government's just trying to prevent recessions. Well, they have to print exponentially more every time we go down now. Like we just did. We just printed as much in 8 months as we did in 7 years after the last,
Yeah, I want you guys to hear what he just said. We just literally printed in 8 months more money than they printed back in 2000 for 7 years after the 2008 crash, that whole quantitative easing thing. And
just to deal with a short-term virus.
Right.
They're going to have to print a lot more if they keep doing it. And see, the point is, I've been telling people that people say, well, the government will always print more. I say, yeah, but they'll get so far that it'll be so ridiculous that it's like a typical addiction cycle where it takes more and more of a drug to keep you from coming down or to get you high because of tolerance. And then it gets so extreme that one day you just pass out and either die or go into rehab.
So
we're going into rehab in the next few years.
Why is the stock market doing so good, Harry?
Because all this money printed, you got to understand, normally what the central banks do, Federal Reserve, to stimulate the economy and slow down, they lower interest rates and make credit more easily available, hoping people will borrow more to help stimulate the economy. Well, they tried doing that in 2008-9. Didn't work. Everybody already so overborrowed, corporations, government, consumers, everybody, that people weren't borrowing. Everybody's too much in debt. Everybody already bought the house twice as big as they could afford, refinanced it 3 times, So what they realized by accident, they did the first round of quantitative easing, $1 trillion for the Fed, probably 3 or 4 trillion globally, that first round. That was just to keep the banks from falling down, okay? Just put liquidity in. And they were hoping that would stimulate lending. It didn't. So normally, you lower interest rates, banks lend, people borrow, they invest, that causes the economy to grow, they pay back those loans, that's the normal monetary cycle. That didn't happen. What they figured out by accident, they didn't intend this. It caused the stock market to go up and real estate to rebound, but the stocks go up more than anything. Stocks have gone up more than bonds and real estate for this entire printing. Because what you're doing in quantitative easing, you're not getting money into the banking system and into consumers. You're simply buying from a fixed pool of financial assets owned by financial institutions largely, because they invest for us. You're injecting new money, trillions of dollars, into the same pool of assets, which just pushes them up for no good reason. How could you explain how stocks would be way higher, twice as high today than they were at the beginning of the last downturn, when the recovery in the economy we had was only 2% growth, the weakest recovery in history? How could stocks go this high? Because central bankers found by pushing up asset prices, and the more you do it, you create a wealth effect. And by the way, demographically, I'm the only person on earth that knows this because I study everything about demographics. The top 20% are not 20% to the economy, they're 50% because they make a lot more money and spend a lot more money. So the top 20% were made more wealthy by this. The average person doesn't have much financial assets and has a 120 grand home in Omaha down the street from Warren Buffett. So they didn't get a big kick from this. Affluent people did, and especially the top 1% and 0.1%. So financial assets got rich people to spend a lot more money. And here's my definition of our 2% growth economy. 0 for the everyday person on Main Street, 4% for rich people not making more money, otherwise having all their real estate and stocks go up like crazy, and they're buying yachts and boats and everything they can get their hands on, and they're reinvesting in stocks. So it creates a bubble, it creates artificial wealth, And that wealth doesn't immediately get spent, but a good bit of it does. And that's the only thing driving our economy.
Wow.
That's artificial. But by doing that, the difference is I think we had about 240 trillion in financial assets globally before the 2008 crisis. And now, before this one, we have 477 trillion, counting personal real estate, on top of commercial real estate and stocks and bonds and gold and silver and all this stuff. $477 trillion in an economy that's weaker than it was, and less strong demographics than in 2007. And that bubble is going to have to burst.
You're talking about the valuation there. The valuation has effectively doubled since 2008.
Same stock, same real estate, and corporate profits have not grown since the first bounce from 2009. Companies have been using cheap money to buy back their own stocks and cause their earnings per share to go up twice as fast as their corporate earnings. So that's artificial too.
And they're borrowing money as well. Yes. And they're borrowing on top of that. So
they're borrowing cheap money to buy back their own stocks, leveraging their money, taking their shareholders' cash flow, or adding debt to speculate in their own stocks. All the net buying of stocks, Rod, since 2009 has been corporations buying their own stocks. Retail investors, institutional investors, foreign investors, if you net it all out, slightly negative. It's corporations buying their own stocks. And then what are governments doing? Buying their own bonds to push their interest rates down and allow them to float more debt. They would never be able to float all this unprecedented debt, especially Japan, in a free market.
So guys, this isn't like conspiracy stuff here, okay? We're not off the deep end here. We're talking about common sense, the printing of trillions of dollars, corporations, the doubling of asset values in a market period where there's nothing to account for it. It's fluff. And then like you say, corporations buying their own assets, and this. So how bad is it going to get, Harry? What's going to, when the proverbial, what hits the fan? What do you think is going to happen?
Well, it's really clear. There's two things that happen long term. When you get a generation peak, like the Bob Hope generation in the late 60s, you tend to get about a long-term 12 to 14-year downturn when they're not spending until the next generation comes on. And it's about a 40-year cycle. So think 26 years up, 14 years down has been the rhythm. You get about a 50% or so stock correction long-term. When you get a bubble like the Roaring 20s, or a bubble like this, stocks crash 80 to 90%, 70% minimum. And so much bigger crash because things are much more overvalued. These stocks have no relation to mainstream. In fact, my spending wave indicator, that 46-year lag, when they're going to spend, when it's going to correlates with the stock market adjusted for inflation long term. Instead, in February of this year, when stocks peaked, at almost 30,000 on the Dow, they were 120% overvalued from where the spending wave accurately over time says they should be with natural trend. So you have to have a big crash to get back down to reality. So stocks, and I've had this target date all the way back to the 80s when I predicted the boom and the longer term downturn. By late 2022, give or take, I expect the Dow to be 5,000. That's about 85% down. The NASDAQ's going to go down a little more than that. S&P similar. That how much money that destroys? It doesn't come back. Real estate, I valued. Real estate. Yep. So in 2006, at the last peak, real estate was about 21% overvalued by my demographic model of net demand. Peak buyers minus buyers, sellers. Now, even though real estate's only about as high or a little higher than it was in 2006 at the last peak or 7, it is 42% overvalued because the net demand is much lower. All this buying is same thing as corporation stock. It's so easy, it's so cheap, it's so easy to get a loan, so cheap, people just buy in more for the hell of it. Oh God, I got a 6,000 square foot. Why not trade up to 7,000? My mortgage broker said, what are you doing setting that 6,000 square foot house, Harry? You should have an 8,000 square foot house. What's wrong with you? So this is artificial stuff too. So real estate is more overvalued. So we came into the last one, and we haven't had a real estate bubble for almost a century, okay?
Right.
It came in 20% overvalued and went down 34% because it overcompensated. I'm expecting about a 50% drop in real estate. Now, high-end more, everyday homes less. Coast, and New York, San Francisco, LA more, Omaha, Chicago, Kansas City less. But that's the ring. People don't have any concept that can happen. Nobody thinks it can happen twice in a row.
Right.
So this is devastating. Stocks, but I go back to that 477 trillion number. That's the magic number, the important number.
Okay.
In the 30s, the last bubble, those financial assets went down altogether, real estate, stocks, bonds, everything, about 50%. So if you lose 50% of $477 trillion,
wow,
you're talking 230, 240 trillion. That is 3 times global GDP. 3 times global GDP, and it's the same ratio in the U.S. We got about 125 trillion of financial assets versus 21 trillion GDP. And if half of that disappears, a little over 60, 3 times GDP disappears.
Wow.
So here's my thing. If you create it by magic, now you see it, now you don't. That's what bubble economics is. You create an artificial thing to keep from going in a downturn, to keep from having to take your medicine and restructure and rebalance, which makes you healthier. The Great Depression, we came screaming out of 1933 bottom, screaming never to look back again, because we got rid of so much private and business and consumer debt and got businesses healthy and competitive again.
Yeah, let's shift gears because we've just scared the shit out of everybody. So now because it is going to get ugly, guys. Now the one thing you indicated previously is you don't think this is going to last a long time. I think you put through 2023 out there. Why is that? Why do you think we're going to rebound quickly?
Okay. Here, and this is where economists are saying we won't have it won't happen, blah, 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 blah. It's not a bubble. When it finally crashes, you know what they're gonna tell us? We're in for a lost decade of 10 or 12 years, just because it happened in Japan, it happened in the 30s. What I'm telling people is we already started what I call the winter season. I've been predicting a winter season after the baby boom peaked in 2007 that would last from 2008 to 2023. That's the demographic decline and the very steep one. Mm-hmm. So we started this in 2008. We had a deep recession. We did not have a depression and a total deleveraging. So in the 1929 to 42 long depression, we had the first crash work. That's what typically happens. It just all falls apart. The biggest crash, highest unemployment hits right off. Then you stimulate, then you bounce, but then you still got weak demographics, and you come back and you have a secondary depression, which they had from 1937 to 1942. Okay. Less unemployment, less stock crash, but still a depression. 2 depressions. Well, we had like a mini depression, 2008 to 9, cut it short. Now we're going to have the big depression, the big crash on the back end, but then it's going to be over because the demographic trends, the millennial generation will drive us up. And I can tell you the date, 2036 to 2037. Just like I said, the date for the baby boomers, boom to 2007. It's not going to last as long as the baby boom boom. It's not going to be as steep. But we will come out of this, and most of the world does, a lot of the world does as well, and the emerging world, Southeast Asia and India, are going to dominate the next boom. You know who dominated this boom? We got richer, Europe got richer, but we were already rich. You know who got rich overnight? All of East Asia. First Japan, then Taiwan, South Korea, Singapore, Hong Kong, and then China was the last and the most massive. They doubled or more their GDP per capita in 20, 30 years. They're the epicenter of this bubble. The U.S. and North America, we were the emerging countries in the early 1900s and roaring 20s, creating a bubble and moving and becoming developed country and becoming rich. So that's the greatest bubble. That's going to be the greatest burst. We're going to have a big bubble burst here, but I don't even want to talk about China, where real estate is 11 times income 11 times income, 22 in Hong Kong, their leading city. And Chinese have 78% of their net worth in real estate. In the U.S., it's 30%.
Wow.
They are going to get.
They're going to get creamed. Okay. Well, which may or may not be a bad thing because of their, their military posturing and all this stuff that's happening. But we won't go down that rabbit hole. But let's talk for a minute. My listeners are multifamily investors or aspiring multifamily investors.
Thank God they are. Yeah.
Yes, that's what I want. I want them to hear from you, okay? Because again, we've just scared the shit out of you. I know that, but I want you to hear what Harry's got to say about the asset class that we are investing in. So please, Harry, reassure them about where they're at if they've got cash flowing assets.
Yeah, you have to understand, unlike a lot of recessions where some things go down and some things hold up, and this, in a bubble crash, almost all financial assets go down. There's two things that hold up. What holds up the best are the highest quality bonds, the 10 and 30-year Treasury bonds, which also went up in value in this flash crash in February, March, and cash flow positive rental real estate, not commercial, residential real estate, and medical facilities. So multifamily apartments and single family rental hold, rents hold up and even sometimes go up because nobody can buy now. Buying is not even an option. You couldn't get a loan if you were a billionaire, sort of thing. And the world looks bad, so why would anybody buy anyway? So rents hold up. Now, properties will still go down to some degree with the real estate cycle. I looked that up. It won't go down as much as residential, and residential will not go down as much as commercial. So, but the rents will hold up. The cash flow will tend to hold up. If you come into a downturn like this with two things you want, cash from selling overinflated real estate or stocks or businesses or whatever, anything you can do to create cash. And you may have some of your properties that are maybe more marginal and not as positive cash flow, or you think are more overvalued. And I'll give you a measure for that real quick. Look at your real estate, whatever it is, commercial, apartments, single family homes, whatever. Your best case on the downside is the lows back in 2009 to 11, depending, different time. Your worst case is where the bubble started in early 2000. So that's your downside potential. If you see a lot of downside potential, you may want to sell it and then rebuy something similar a couple years from now. But there's also a value to having cash flow. You walk into a downturn, especially in real estate, there's going to be a lot of people failing. In real estate, all types of businesses, there's going to be a lot of stuff in foreclosure. Let's say you got a bunch of apartments or a bunch of single family homes you have, and you got strong cash flow. And all these other properties are going under. They can't pay their bill. The bank says, what do I do with this? You come and say, I'm not going to give you a dime. I'm going to take over 50 or 60, whatever I can, 50, 60, some percentage of that mortgage, which is better than fire selling it and getting nothing. And I'm not going to put any money down, and you're going to give it to me because I can pay the payment. Their banks aren't going to find many people that can pay the payment. So cash means you can walk in and steal something and not have to wait to get a loan, which is going to be impossible. Cash flow means you can take over properties. So I would look at my properties and look at the whole array. The best strategy from my point of view is have some of both. Sell the properties you can pull the most cash out of, which means the ones that have the least debt, not the most, okay?
Right.
You can pull the most cash out to create a cash chest, and then keep the properties with the best positive cash flow. And the combination of that cash and cash flow makes you king in a deflationary spiral where even if you don't want to just buy more apartments, you buy stocks, businesses. And I'll tell you, it wasn't just Joseph Kennedy that did so well in the Great Depression. He came in with cash, bought businesses. The mafia made tons of cash flow, illegal booze in the roaring 20s, and then turned into loan sharks for failing small businesses in New York and Chicago, where they're in the Great Depression charging 20% loans. Now you think about this. If a loan fails, are they going to pay the bank or are they going to pay the mafia? They're going to pay the mafia because they're going to break your legs if you don't pay it. High loans, and even if a business failed, what do? They take over the business, and then when the economy turns around, they got a business for nothing. So, they're cash and cash flow. And the key to me, not only to build as much cash and cash flow coming into this, because this is going to happen soon. I think stocks may be peaking next week or at the latest by the election. Okay.
Wow. Okay. So guys,
stocks is the leading indicator for everything else. Real estate is holding up the best, because there's scarce inventory after the 2008 bust. Builders never came back strongly. There's scarce inventory. People are panic buying. The stock market's going to lead this downturn. Real estate led the last one. So that's your lead. You see stocks start to crash, and I think you can see it very soon. That's your sign. Okay, I better get my act together. So look at your portfolio, and I would not only be trying to raise as much cash, I would be targeting today. I'd be looking today, what apartment buildings or what single family areas do I want to buy in cheap and be able to rent out during the downturn? And then in the case of single family homes, you also have the option of selling it, when the economy comes back years from now. Rent it in the downturn and rent it for years to follow when people are still shaky and can't get a loan and think real estate will never come back. And it won't come back, by the way. Rent cash flow. Well, here's probably the most important point, Rob. Real estate temporarily from 2000 to now switched into a speculation market. You make most of your money on speculation, not on honest rents.
Right.
It's always been rents. The value of a house or anything or office building, what can you rent it for in the next 10, 20 years discounted to the present by a 10-year treasury bond, risk-free treasury bond, just like stocks. What's your 10 years earnings forecast discounted to the present, okay? Or if you're buying and not renting out, how much rent can I save in the next over this mortgage compared to the mortgage payments of property? That's what would tell you whether something's fairly valued or a good deal or not. Not, it's been going up this much, so it's going to go up this much more. That is stupidity. This is going to end. We will not see real estate bubbles for the rest of our lives, at least in the developed world, maybe in India. Okay. So the whole market for real estate is going to shift. How do you make money in real estate? Like monopoly, on rents.
Right.
So real estate's worth what you can rent it for, not because it's going up and
value's irrelevant.
Expected to go up more.
Yeah, value's irrelevant. It's all about cash flow. Period. The other thing is there are other renters coming into this cycle as well, like retirees. Yes, I mean their rental wave coming.
This is a godsend to your industry, right? I didn't get this till I spoke at a big apartment conference last year in Dallas. I've been telling people in the multifamily, hey, the millennials, by the way, are peaking in 2018-19. The first thing you buy or rent, first stage of real estate is apartments until you can afford, you get married, have a kid, and buy a house.
Right.
So that peaks earliest. So the millennials who peak births were 1990, already peaking at 27, 28 apartment thing, coming into this. Now, the downturn will keep the rental market buoyant for reasons I said earlier. But there is a new trend. And remember what I said earlier? Baby boomers are a changed generation. Every sector they enter, they bring some new change. And the new change, not by their intelligence, I hate to say it, because they're forced to. Baby boomers grew up in good times when they were younger. They're not like the Bob Hopers that saw, first, when they were young, they saw the Great Depression in World War II, the worst entire period in all of U.S. history. So they saved for a rainy day. They didn't overspend and overborrow. Baby boomers just spent, didn't save, and here they are now moving into retirement at record rates, and they don't have a retirement plan, or very little one. Right. So what they realized, just by happenstance, wait a minute, I'm sitting in a McMansion typically, my trade-up home, not my starter home, and I've almost paid it off now that I'm 60 years old or whatever, a lot. And it's worth a lot in this bubble. I don't know why, but it is. And what more and more baby boomers are deciding, the only way I'm going to fund my retirement plan, because I was a dumbass and didn't save, is to sell that McMansion, and instead of reinvesting in a smaller downsized home, which normally people would do if they don't stay in their home, which I say about half stay in their home, half of them downsize. No, I can't even afford to put 2/3 of it back into a smaller home. Right. I need that whole profit to fund my retirement comfortably. So they're renting. Increasing percentages of baby boomers 55 and older are renting instead of buying or downsizing in retirement. And that is the new boom. And not only is that's where all the growth is going to be in the coming next 2 decades. All the growth is baby boomers renting, and not all of them, but increasingly renting retirement. And the best part of that, Rod, who would you rather have? 25-year-old crack addict,
Right.
parties every weekend, renting your apartment or home and burning it up, trashing it down, and who only stay with you? They get out of college 22, and as soon as they get married and get a good job, they leave you in 5 years and go buy a home. These people could stay with you for 20 years if they decide to rent.
Forever. We've got an asset.
And they got higher income, and they're more responsible.
Yeah. No, I mean, case in point, we've got an asset here in Sarasota. It's just under 100 units, and it's age restricted, 55 and older, and it is always 100% occupied with a waiting list, and they never leave. Why would they? So what's the point? And so, I'm looking at one of the slides from your presentation that you did for the mastermind, and it shows, in 2025, 13 million renters over 60 and 16 million plus 35 to 60. And then really the smallest number is under 34. It's
right.
Really,
the normal good market is the smallest number.
Right. Fascinating.
And that market's going to be flat at best. Almost all the growth is going to be middle-aged to older people. And again, this is a new trend. First of all, people didn't live so long a generation or two ago. And second of all, older people are the least likely to rent unless sometimes they'll rent when they're very old, maybe their last 5 years, like screw it, or they'll move into assisted living center or something. Right. But this is a new trend, and boy, I tell people, everybody says, this is the biggest misconception, Rod. The millennial generation is the largest generation ever. Yes, in total numbers, because they started at much higher births and they were born over a longer period of time than the baby boomers. As a wave of people, they're a 4-foot wave. The baby boomers are a 10-foot wave. Anybody that can find a way to keep selling products and services to the aging baby boomers who have way more wealth and often have more income than younger to 30s or 40s millennials, you're going to grow faster. My number one growth segment in consumers is nursing homes and assisted living facilities. And you know what? If you can deal with grumpy old people, which I don't know if I'd want to, but there are people that are turning McMansions, which will be the greatest part. McMansions will fall the most. They'll be the less needed, and the millennials won't be buying them for another 10 years or something. They will fall the most. You can turn those into small, peaceful, suburban assisted living centers and get in a network of expertise and make 2 to 3 times what you would renting them. And imagine if you could buy that house at half the price or less, how much more would your cash flow be?
Yeah,
so
that's exciting.
So that's another thing. Anything you can do. So more aging boomers are going to just rent their retirement home, and they're going to be moving in an assisted and nursing home faster than anything. You want to get in that market, you make even more money. Just, you have to consider if you're willing to deal with grumpy old people.
Give us your opinion about urban versus suburban as it relates to renters.
Well, I always was told, the baby boomers, when they do, the ones that do downsize, they move out of a McMansion in the suburbs into the city, closer to restaurants and hospitals and da-da-da. Nope, wrong. Yes, some of them do. Nope, the statistics, all these projections I showed in my presentation, nope, the growth is all older, higher income, and suburban, and no kids. And that's another good thing. No kids to tear up your plum. Not just the partiers, no kids to chew on things and puke over everything and whatever they do, So it's a better market, and they still prefer the suburbs. Look, if I'm an older person, I'd rather be in a peaceful suburb, or actually an exurb, even farther out. The outer suburbs are probably the ideal places for older people to retire.
Interesting. All right, so just to recap, guys, the stuff is about to hit the fan. It's going to be really ugly, and with crisis comes opportunity. You heard me, I stole Jay Abraham's phrase, ethical opportunism or compassionate capitalism. There's going to be tons of opportunity, and cash will be king, and not just your own, your ability to raise cash as well. I'm going to be raising cash with partners to take down these assets and joint venture with me for sure. I'm going to be doing that, and then cash flow as well. Like Harry said. So, forewarned is forearmed, guys. And so, and I'm not here to try to scare you. Harry's not here to try to scare you.
I've been the most bullish economist in history, but the great booms also have great downturns. We're in a short period of time that's going to be different. This has been the greatest economic expanse in all of history since the late 1800s. We're living in prosperous times. This is just a big hiccup on the way.
Yeah, and guys, in crises like this, rents maintain. It's the prices that go down. Rents stay pretty constant. So again, we're in the right business, my friends. So again, not something to fear, something to be aware of, to get excited towards. And guys, Harry puts out a newsletter. It's harrydent.com. Do you want to talk about your monthly newsletter for a quick second here?
Well, yeah. We have a paid monthly newsletter, which I tell you in these times, I would say go to hsdent.com and just get on our paid newsletter because it's such a critical time. But we also have a free weekly newsletter. Every week you get an article from me and my partner, and every other week I do a video rant, but kind of like this for maybe 10 or 15 minutes. So that's for people to get to know us, and it's free. So harrydent.com, you put in your web address, you're on that, end of story. I would advise at this time, why not just go to, there or hsdent.com. I would advise get on my hsdent forecast, because I'm telling you, this is going to be a wild ride.
Wild ride. Yeah. Well, listen, my friend, I really appreciate you adding value today. And guys, again, forewarned is forearmed. Get ready. Don't fear it. Get up to speed. Learn this business as fast as you can so you can capitalize on the incredible opportunities that are coming. If you could come spend some time with me at my boot camp, do it. I promise you'll be glad you did. And Harry, thanks, my friend. I appreciate you coming on today.
Thank you, Rod. Good luck. Sale of a lifetime coming. It's more of an opportunity if you see it coming.
Sale of a lifetime. And this will likely be the biggest opportunity we see in our lifetimes. Yes?
Yeah.
Right. Okay. All right. Thanks, buddy. Take care.
Rod, I know a lot of our listeners are wanting to take their multifamily investing business to the next level. Now, I know you've been hard at work helping our Warrior students do just that using our ACT methodology, which is awareness, close, and transform. Can you explain to the listeners how they can get our help?
You bet. Guys, we've been going nonstop for 3 years, building an amazing community of like-minded people. And our coaching students, which we call our Warriors, have had extraordinary results. They've purchased thousands and thousands of units. And last year, we did over 1,000 units with our students. And we're looking to grow this group and take it to the next level. We're looking for people who want to follow a proven framework that's really step by step, and then leverage our systems and network to raise equity, to find and close deals, and to build partnerships nationwide. Now, our Warrior community is finding success in any market cycle. So if you're interested in finding out more about how you can become more of our incredible network and take advantage of the incredible opportunities that are coming very soon, apply to work with us at mentorwithrod.com or text CRUSH to 41411. That's mentorwithrod.com or text CRUSH to 41411.